Welcome to the Embrace Her Legacy podcast, the #1 personal development classroom for millennial women, hosted by Embrace Her Legacy founder and CEO, Maria I. Melendez. Ladies, get ready to evoke your feminine confidence and be inspired to master your relationship with yourself so you can fabulously live your legacy. If you enjoy this podcast, please make sure to subscribe. Don't forget to visit us at embraceherlegacy.com, where you can support our mission by making a donation of any amount or sign up to become part of our community of volunteers and supporters, the Embrace Her Legacy Collective. Our vision is for every woman and every girl to defeat her inner saboteur, master her relationship with self, and live out her legacy unapologetically. Enjoy the podcast.
Hey, welcome everybody to the Embrace Her Legacy podcast, the #1 personal development classroom for millennial women of color. And I have our most guested guest. I don't know how to say it any otherwise. I was like, how do I say most times? I was like, she's just the most guested guest. And this is her 3rd time. She's the only person who has literally sat with us 3 times. And that's because she's the only person I know to talk to about money. And her name is Keishan Rowe, joining us today. We're going to be talking all about taxes 101. She's an accountant, a tax strategist, and financial coach. And you can catch her on Instagram at _legacy_lady. We got questions. So Keisha, we're recording this week, but it's going to come out next week, which would have been normally April 15th. Is like tax cutoff day. So this will be coming out on April 14th. And that was done strategically so that, you know, we can talk about taxes. But for those of you who do not, those of in the audience who don't know you, introduce yourself, tell them about what you do and how amazing you are and all that shit.
So as always, thank you, Maria, for extending the invitation, not 1, not 2, but a 3rd time, right? So I don't, and I always say this, you know, you could have reached out to so many other different people, but you actually taking the time to reach out to me, despite it being busy season and it being a crunch. You know, I love what you do for your audience. So yeah, I'm here for it all. So for those of you who don't know me, my name is Keishan Rowe. I'm an accountant by profession, tax strategist, as well as a certified financial educator and financial coach. And as I always say when I have the opportunity to come and share with Maria's audience, I love giving this information to people because, you know, people that look like you and I or Maria and I, they don't get this kind of information unless they pay for it, right? And so sometimes even when you pay for it, it's not even that great. Hello, somebody.
Hello.
So I love to be able to really just take the time to really just share, you know, the information that I have been schooled with. I got that degree in accounting, and have over 15 years of experience working in financial accounting, working on corporate tax return, high net individuals. So I'm ready for these questions. Let's go.
Let's get into it. All right. So let's start with the very, very basic. So we're going to build on this conversation. It's going to go from like A to Z, because I'm pretty sure by the time we get to like M, I'm going to be like, I don't even know what she's talking about because it's so much. There's so much we don't know. And so let's start with, let's just define why do we pay taxes and where do our tax dollars go?
So pretty much we pay taxes pretty much to the government. So this is the government's main source of income. So if we don't pay taxes, they don't have this additional funding coming in. So we are taxed, and what happens is they use that money, and that money is what they use to do funding for roads. This is what they use to pay for, you know, the law enforcement, the police department, you know, public school systems, the library. They use all of that money that we pretty much have, that we pay to the government to fund those different things. So yeah.
That's the basics. All right. So another basic question. What does it mean if something is tax deductible?
Okay, so what it means to have something or use that terminology as tax deductible, it pretty much means it's an expense that a business or an individual can actually deduct on their tax return. So the way deductions work is your AGI, your adjusted gross income, or that's if you're an individual, or your profit, it helps to reduce that amount. So at the end of the day, whatever your taxable income is, that is what you're going to be taxed on. So these deductions are used to reduce the amount of income that you have to ultimately reduce the taxes that you owe to IRS.
See, I know who to speak to. See why she's been the most guested guest? Because she see how you broke that down so simply, so clear, so concise. Okay, so all right, let's go to like B now. So now it's January 1, the beginning of January. Now everybody's talking about filing their taxes. Are there benefits to filing your taxes early, first and foremost?
So I would say the only benefit per se is that you have an idea of what your tax liability is going to be. So let's say you file your W-2, you receive your W-2, and you realize that when you file it with your tax preparer that you owe $3,000. So you probably have a couple of months to prepare for submitting that payment to the IRS, because you have up until April 15th, as opposed to if you wait until April 14th to file your tax return, then you only have 1 day to come up with where I'm going to get this $3,000 from.
What? I didn't know that. So if you have a tax bill, the tax bill has to be paid by April 15th?
By April 15th. Regardless of if you put it on extension. So I know you're pretty familiar with that term. If you can't file your tax returns timely, the IRS gives you an opportunity to file a 6-month extension. So instead of it being due April 15th, it would be due October 15th. But the caveat is they say you can extend it, but we still want our money. So you still have to pay by April 15th.
But how would you know if you didn't file, right? How would you know if you had that tax bill if you didn't file by April 15th?
Well, so that's the thing. When you prepare your tax return, people typically know, well, your accountant will let you know that you have this liability due. So this is where the problem people run into. They believe that, oh, if I didn't make, a lot of money, or if somebody didn't give me a W-2, I don't have to file. I've had plenty of clients who received unemployment and they thought they didn't have to pick up unemployment on their tax return. You have to pay taxes on that money.
So pretty much you have to pay taxes on any type of income that's coming in.
Everything. And so what's happened, I don't want to jump the gun. I'll wait until
we get there. Okay, so yeah, that's gonna be like MNOP. Like we build it. So all right, you talked about accounting, but now there are tax preparation services. Do you recommend going with a tax accountant or using these tax preparation services?
Okay, so the tax preparation services are cool. Honestly, if you just have a simple W-2, you might not need to pay an accountant that is going to charge you probably $200, $250, $275, depending on the accountant. You could just buy TurboTax. And so TurboTax had this offer that if you filed your returns by, I believe, like March 15th, your tax return was actually free.
Okay.
So in those instances, you don't have to pay anything, as opposed to you using an accounting individual to file your tax return. There are some benefits, though, when using a tax professional, obviously, but the discretion is up to the individual.
Okay, so some of our audience, they're a little younger, right? So for someone who's starting out and they definitely can't afford the tax accountant, what advice would you give them in preparing their taxes in their early 20s? Are there records that they should be keeping track of throughout the year?
Yeah, so what I love now, this is a generation who are self-motivated. We have a lot of young people who have their own businesses, right? So if you're someone who has your own business and you may feel, maybe I want to try to do this on my own, maybe for the first year, you should probably consult using a professional if you have a ton of expenses and stuff, right? But let's say you don't have, a business that you started on the side. The records that you want to keep in general, you want to make sure you keep a copy of your W-2. You want to make sure that any interest income that you receive from the bank, from having money in your bank, you want to make sure you hold on to that. If you paid for any student loans or anything like that, so 1098, not 1098E, 1098T, whatever forms you receive, you want to hold on to it, because in the event that the IRS has any questions, you can provide them with all that documentation. So you want to make sure you hold on to it for at least 3 years.
3 years?
Mm-hmm.
What? So the IRS can come looking for your returns from 3 years ago?
Yeah, the statute of limitation, they can come back.
See, I knew who to speak to, because this is information. Y'all better be writing this down. So you said that 1098, right? And I'm familiar with 1098 because I pay back student loans. But what tax benefits are eligible for, like, college students, grad students, or even somebody who's paying back student loans?
So the benefit associated with any kind of form that you receive, especially the student loans, depending on your income, you could get a benefit for the taxes the amount that you paid on any student loan. So you'll receive student loan interest that you can deduct on your tax return. But then again, the thing about it is, I always say, Biggie Small says, more money, more problems. So the more money you make, the less deductions you are typically eligible to receive, because you start to phase out over time.
Got it.
It's great that people are getting the higher education, but sometimes there are some limitations.
While being a student, are there tax benefits while you're following as a college or grad student?
Well, if you're paying for books out of pocket, you want to keep an account for that, because those could potentially be tax deductible. All of those little things that you're doing for your school that are not typically reported on any kind of forms, you want to hold on to those, because those could be potentially tax deductible.
Wow, this is interesting. Okay, so let's talk about common tax benefits that people tend to miss out on. You talk about deductions. So let's categorize the W-2 person. Yeah. What are the common tax benefits, deductibles that you see people kind of missing out on?
So the interesting thing, as a W-2 employee, unfortunately, the benefits that are out there are not that advantageous as if you were self-employed, right? So the new law this year for individuals, W-2 employees, for everyone, you're able to deduct up to $300 of charitable donations on your tax return. So in the past, a regular W-2 employee who didn't own a home didn't have that benefit. In order to deduct certain things on your tax return that were of higher value, you would have to file something called an itemized deduction. So like medical expenses, a person would think they'll be able to deduct that. So as a W-2 employee, you have your medical expenses paid through your job, but let's say you started to pay certain things out of pocket, right? Which is a bad thing, because who wants to pay for medical expenses out of pocket? The thing about it is now that it has to be a certain amount over the threshold for you to actually deduct those amounts. And again, you have to itemize. So if you don't itemize, then you won't be able to get those deductions. So
okay, I was gonna say, can you explain what itemized mean? Because some people may not know what even that means, girl.
Okay. So difference between, so a typical regular employee or individual, when they file their tax returns, they'll get the benefit of getting an additional deduction. So Congress says, or on the IRS form, they're going to give you a deduction. The deduction is broken up into two categories. The standard deduction, which typically 90% of Americans fall under that, or you have the itemized deduction, right? So under the itemized deductions, it's things like if you own a home, if you have a property, you get to deduct the real estate taxes. You get to deduct the interest associated with that property that you have. You get to deduct that medical expense that I mentioned,
Right.
charitable contributions. You get to deduct a whole bunch of different things. So a lot of Americans aren't homeowners, so they don't fall under that category to deduct the itemized deduction. And so even in some situations, let's say you do have a home, but if your standard deduction is higher, so if you're single, right, a single person, their normal deduction is $12,400. Right? So when you do your tax return, you automatically get a deduction, which means what we talked about earlier, it reduces your AGI, right? Okay. So everybody gets that standard deduction. But let's say you have a home and real estate taxes, interest, all of that. Let's say that together was over the standard deduction of $12,400, then you automatically get the itemized deduction. It's just like the way I want your listeners to think of it is like let's say you're itemizing a bill. So you're looking at each little line item. So you get to deduct certain things when you itemize it, as opposed to just taking the standard deduction that is given to you.
That makes sense. That makes a lot of sense. So if the standard deduction is 500, you could get the standard deduction, or you can just go line by line and say I'm deducting A, B, C, and D. That's what makes sense. Okay. So you mentioned home ownership, right? So there are tax benefits to owning a home, because recently a friend of mine and one of her friends, she was like, oh, she got a nice return because of owning her home. So I didn't know that was actually a benefit. Can you share more about benefits for homeowners?
Sure. So it goes back to what I just explained about being a homeowner. You have the option of deducting the actual property taxes associated with that home. And so we live in New York. So especially, and I live on Long Island. So the property tax out here is ridiculous. My property taxes are about $13,000-$14,000 for the year. Wow. And then there's interest associated with that.
Wow.
Right? So just like think of when you're paying back your student loan, because that's pretty much what's happening. I'm paying back a loan that I got on my property. So a lot of the money is going towards the principal, but also an amount is going towards the interest. So as a homeowner, you get the opportunity to not only deduct the real estate taxes that you paid, but also the interest that you paid on there as well. And so that's why that interest income that I was the itemized deduction that I was speaking about earlier made sense, because you get to deduct all of these line by line items. Now, back in 2017, there was a whole big tax reform where they changed the rules. And so someone like me who had real estate taxes that were over $10,000, Congress said that, you know what, you only can deduct up to $10,000 of real estate taxes. Yeah, they played me.
So you literally miss out on the extra $3,000-$4,000 that you could have had deducted to reduce your AGI. Ha, I've been paying attention.
Yes.
Okay. Okay. Wow. And that stands for every state or just New York?
No, this is a federal.
Oh my gosh. So if you have a mansion somewhere in Beverly Hills, it's caps at $10,000.
And what's included in that tax, $10,000, is your W-2 state taxes as well. So if you're a high net worth individual, and let's say you're making $1 million, and I've had some clients where they were literally their W-2. And so one time this is the thing, as an accountant, you have the opportunity of working on some really great projects, but then you sit there and you like, I'm working on someone's tax return who is getting paid millions of dollars. One guy's tax return I worked on, his W-2 said $2.5 million. First of all, what are you doing with all of that money?
What? I want to know, what did he do for a living? Like,
he was like the CEO or CFO of a major technology company. And he was under 30. Girl.
No way. Was he single?
I had to do the quick Googles. I had to get the quick Googles and like read up like who is this person? Because I saw W-2 and I'm like, what in the world? Yeah. And his
What?
taxes were close to $1 million.
What the taxes that he had to pay?
Yes. So on his W-2, he had 2.5 million of income, and his federal taxes were probably close to $1 million, and then he had state taxes as well. So remember, when you itemize, you get to deduct your real estate taxes as well as your W-2 state taxes. So he's only capped at getting $10,000 of a deduction.
That is highway robbery.
Yes.
You know what? And Keishan, where do we find out this stuff? Like, why don't we get the emails when something like this happens? Like, how is this not common knowledge? And again, it goes to your point at the beginning of this conversation that people that look like you and me, we don't know this. I don't know this.
And I think a lot of it, so we are so fixated, not us, but the school system is so fixated on teaching children the fundamentals of adding and subtracting, but they don't teach them how to think outside the box, right? And so it causes people to not understand how to run a business, how to understand a tax return, being up to date with what's going on with Congress right now with the stimulus and everything like that. You know, a lot of individuals didn't know that if they receive unemployment, then they could be forgiven of up to $10,200. Like they don't have to pick that up in their income. And so,
get the heck out of here.
So that was rolled out under the Congress sent that out saying that, the IRS sent that out saying that if you were unemployed and last year you received a 1099-G for unemployment, and you were paid out, let's say $20,000, $10,200 of that is forgiven. You don't have to pick that up in income.
Why? Who again, Keishan? Why did we get the email? Why did it like nothing? This is because do you know how many people collected unemployment last year and are filing that on their taxes? And I didn't know anything about that. Like, how would we go about keeping abreast of all these tax laws that can be pertinent to our day-to-day lives?
So I would say one of the main things is to keep informed as to what's going on in the news, because sometimes the news, they like to share what they feel is relevant at the time, right? But in addition to that, it's just become very savvy at, you know, doing your Googles, looking up stuff online, reading, doing the additional reading, going over to the IRS website, because they always have new tax alerts or new updates, which will give you an opportunity to see firsthand what's going on.
Whew. I feel like we need town hall meetings. Like this is insane. I didn't know all of this. Okay, so let's talk about the benefits for the self-employed person. So what are some benefits for someone who is self-employed on his or her tax return?
So one of the benefits about being self-employed is that things that a typical W-2 employee can't deduct, you're able to deduct. For example, everybody and their mama is at home working remotely. I'm working remotely, you're working remotely. As a W-2 employee, even though it's mandated by our job for some of us to still be working from home, we cannot deduct any home office deductions. We can't deduct our home as a home office because we're not self-employed. So
that's crazy. Even while we are all mandated to work at.
Yeah.
You see what I'm saying?
I've looked in because I'm very aggressive with, you know, coming up with the best tax strategies for my client. So I was doing a lot of research, reading to see if there was any exception to the rule. And obviously there are exceptions, but due to COVID, it's not considered one of the exceptions. So as a self-employed individual, you get to deduct a portion of your home if it's used exclusively for business and it's not a part of any other like your bedroom or anything like that, you're able to deduct that on your tax return. And so what's included in that is your utilities. You could potentially deduct that. You could potentially deduct, the lights, like I said, the telephone, the internet, all of these things you could deduct as a self-employed individual as opposed to a W-2 employee.
Okay, so self-employed, right?
Yes.
What can that mean? Because for some people, they feel like the only way I'm self-employed is if I have a incorporated LLC. Are there ways around that?
Absolutely.
Yeah.
So according to the IRS standards, anyone who is in the business to generate income has a business, right? So I had a client last year, she was in the business of, selling, what is it? Coquitos?
Coquitos, yeah. Mm-hmm.
So she was in the business of generating income.
Okay.
Because of that, she had expenses. And so I told her, I was like, if your expenses outweighed your income, you might as well take into consideration deducting those on your tax return. You had income, and again, the IRS considers anyone who is in the process or is generating income, they have a business, even if they didn't register with New York State or whatever state they live in, you have a business.
Oh. So this is even if the business is not an incorporated registered business, the IRS sees it as you still have a business.
Yes. Yeah.
Okay. So let's get into the corporation, because people have these questions all the time. Mm-hmm. So are there different benefits tax-wise to filing to getting an LLC for your business, an S corp, a sole proprietor? Like, are there different tax benefits for each one?
So I think big picture, the benefit is that as a self-employed individual, as an LLC, as a S corp, as a regular partnership, whatever your structure is, you have the opportunity to deduct expenses. So whatever income you have, you can offset your income by the expenses that you do have. Now, the tax benefits for an S corp are very different from someone who is just a sole proprietor. So a sole proprietor is someone who is the only owner of that business, right? So you could be a sole proprietor and be doing your business as whatever name that you have, and not legally set up the entity structure. So once you decide to set up the entity structure, then you would be considered an LLC, right? And so a sole proprietor and an LLC, the only difference between those two entity types is that an LLC is legally protected. So in the event that somebody wants to come after them, they're not coming after their personal assets, they're just coming after their business. But if you're a sole proprietor, they can come after all your goods, right? Mm-hmm. But the tax benefits are the same, because you're still, as a LLC, depending on if you decide to make an election to be considered an S corp, if you are an LLC, you are still taxed the self-employment tax of 15.3%, which is relatively high, because
oh jeez, I'm over here like, these numbers. Okay,
so in addition to your income tax and your state tax, and if you live in New York City, your local tax, you also have to pay self-employment tax of 15.3%, which consists of Social Security and Medicare.
That was the next question, because one of the questions someone submitted was, why am I paying more taxes as an independent contractor, self-employed person than my friends who are employees?
Because you are paying, so you're paying an income tax, a state tax, a local tax, and as I mentioned, this self-employment tax. Now, if you were a W-2 employee, your job takes care of a piece of that. So because you are self-employed, you have to pay as an owner and as an employee. So why you pay 15.3%, which if we divide that up is 7.65% for the owner, which is still you.
Yeah.
Employee, which is still you.
So, you know what? The IRS finds a way to say, come up off our money. That's really what it is. So there was a research article that we pulled up, and it said many entrepreneurs and self-employed workers don't file taxes for this very reason, right? And 32%, according to the research article, 32% of self-employed and workers, entrepreneurs admit to not reporting all of their income to the IRS. And I think this
is why.
This is why. Now, do you recommend or do you encourage self-employed individuals to file and claim everything, right? And what are some ways that they can reduce that tax bill?
Okay, so the first thing is I absolutely encourage clients to use their best discretion and include that information on their tax return. And this is the reason why, right? So there are a lot of people who went through the process of having really great businesses but weren't accounting for all of their income. So last year when COVID hit, there was so much free money that was being offered. And because they weren't accounting for all of their income, the amounts that they were getting were based on fictitious numbers, meaning not a true reflection of their income. So this is what's happening now when people are signing up for, the Paycheck Protection Program loans that are out there. That is based on their 2019 or 2020 tax return. And so if in a respective year like 2019 or before that, you really didn't account for your income the way you should have, then when you go to ask for a loan, they're going to say, you didn't have any money in your business, so why would I trust you to give you more money? So in actuality, you made probably close to $60,000, $70,000, but on your tax return, you only put down you made $10,000 of income. And so in the immediate present, you worked out and you saved yourself a ton of taxes, but in the long run, you kicked yourself in the butt because no one is going to give a business that doesn't look like they're generating money because you decided to hide that money.
This is so good.
All right. 22.
This is good, Keishan. Like, this is amazing. So how can they, I'm in the self-employed, category too. So I want to know, like, how can we reduce our tax bills? Is it just doing what you said, keeping track of our expenses? Is there anything else we can do?
I would say that's why it's important. And I tell my clients all the time to have tax planning meetings throughout the year. So just meeting with your accountant in February of each year just to file your tax returns by April 15th is doing a disservice to you. Okay. And so if you have an accountant and they're not probing you or trying to have you, do tax planning throughout the year, they're also not adding value to you as a business owner as well. Because there are a lot of things that you can take care of within the year to help reduce your taxes come next year. Because if we're honest, by the time you file your tax return, it's too late. Like you're accounting for income and expenses that you incurred in the previous year. And if we're having a conversation close towards April 15th, then we can only plan for that year for next year.
So is there a way that somebody can pay, someone who's self-employed, can pay those local, state self-employment? Can they pay that quarterly or only once a year?
They can pay it quarterly, and it's more advantageous and beneficial for people to do that because Congress, while the IRS will hit you with a penalty and sometimes interest for you not making timely payments throughout the year. So making quarterly payments is very beneficial. And so this is why I say if you're working with an accountant, they should be having this conversation with you to make sure that every 3 to 4 months, they're taking a look at your income to make sure how much money you should be putting aside for taxes.
Right. So what I do is I have a separate account for taxes. And that leads me to my question about tax brackets. So could you talk to and let people know what is a tax bracket? And how do we discover what does that mean, and how do we discover what bracket we're in?
Oh, so your tax bracket pretty much means that based on your income, you have to pay taxes based on how much money that you earn. So, let's say you earn maybe $40,000, then you might fall into the 10% bracket range, or, everything is based on the amount of income that you earn. And so how individuals can pretty much find out what's their tax bracket is by simply going over to the IRS and just going over and researching where do you fall in relation to your income. And so even quick Googles, if you Google search, you could find the same kind of information as well.
That's good. So if I'm a self-employed person, let's say I'm making $100,000 a year. I can put that in Google and say, all right, this is my tax bracket. I don't know if that qualifies to 30, 40, I don't know how much percent that is, but now I can plan ahead to say, okay, let me make sure that I put away 30% of my income in another account so that I can pay that once a quarter and run that through with my accountant.
Yes. And so I tell my clients all the time, make sure you have between 20 to 30% of tax money on the side. So just in case that tax bill comes up, you're not surprised come April 15th.
Look at that. See, we solving problems over here. Okay. So let's talk about retirement accounts and tax-free retirement accounts like your 401k.
Mm-hmm.
So this is another question. Should I take a loan from my 401k if I run into financial hardship? If so, what will my tax penalties be?
Okay, so the thing about that, so again, the amazing thing, so COVID presented a lot of tax incentives for individuals because they realized that a lot of individuals were struggling. So they allowed individuals to be able to pull money from their retirement up to $100,000 and they not be hit with the penalty that's associated with it. So if you, So if you took money out of your 401k and you say you took out $100,000 out of your 401k, you would be hit with a 10% penalty, which is $10,000.
Right.
On top of the taxes on that amount of money that you took out. But what they put into place was that individuals who took out the money, $100,000 due to hardship, they didn't have to pay the penalty of 10%, and they had the opportunity to divide that money. Well, the income that they pulled out and the taxes, they were able to divide that over 3 years. So it helped to benefit them. But typically, I tell my clients to make sure that's your last resort because you're pulling away from your future to take care of something now. And so most of the times, you're probably not going to pay it back because sometimes you could take a loan against your retirement and then pay it back. But in some instances, people just don't have it. So if you have money in your savings account or in another, a Roth IRA account or whatever kind of account, you want to kind of think of pulling from like a Roth IRA, you could pull out the money that you put in and not necessarily the gains.
Right.
So that will be beneficial for you in the long run because you're not necessarily pulling away too much.
Okay. Well, I know what a Roth IRA is. I love Roth IRAs, but can you explain what a Roth IRA is?
Okay. So a Roth IRA is different from a traditional 401k. So a 401k, just to give your audience a little background about that, a 401k is when you have the opportunity to contribute to an employee-sponsored plan. And so typically your employee, as an incentive for you putting money into the plan, they say, you know what, we'll match your donations. Yep. So let's say for every dollar you put in, they put in $1. So that's free money, right?
Free money for your retirement, ladies. Free money. Yep.
So if you have a 401k at your job, don't play yourself. Make sure you sign up and contribute money into it.
Yep.
And the thing about that, with a 401k, you're contributing pre-tax dollars, which means you're putting in the money before you get your money for working. They take that money out of your earnings, and that also reduces your wages, which is another tax planning strategy that W-2 employees could also take advantage of, right? And so now that policy is pre-tax dollars, but a Roth IRA is post-tax dollars, which means once you get paid, you take your earnings that you made, and let's say you want to put into a Roth IRA account $6,000. You get to let that money in that account grow tax-free because you already paid taxes on it. Yep. And so when you get into retirement and you pull that money out, it's also tax-free.
This is great.
So all of my like Tesla stocks, and this is like a whole conversation, a different conversation, but like my Tesla stocks, I have some of my Tesla stocks in my Roth IRA because I project
you Tesla. Can do that?
Yeah, girl.
How can you do that?
Yeah, so you set up your Roth IRA account,
and
you just buy whatever stocks that you want to buy, and you contribute it into that particular retirement account.
And see, every time I talk to Keishan always gives me homework. You don't know, but you gave me her because the last time we spoke, you told me about a stock.
The REITs, the real estate.
Oh, girl, I went on Robinhood the next day and had a blast. I was like, do that. So, okay, back this up. I can buy stocks and put those shares in my Roth IRA.
Yeah, so I don't know what Roth IRA. If you have a Roth IRA, which brokerage company you're using, but I use TD Ameritrade. So just like you would buy stocks on Robinhood or wherever your financial institution, you'll just go into your Roth IRA account and you'll fund it, and so this is the thing, you can fund it up to $6,000.
Okay,
that's the maximum amount you can put in.
A year.
Yeah, a year.
Okay.
If you are, I believe if you're over 65, then you can contribute up to $7,000. Either 59 or 65. If you're over that age, then you can contribute $1,000 more.
Okay.
And so you put your money into the account and you just fund it. You fund it and then you just buy stock. So if you want to buy Tesla, if you want to buy a stock that you think is going to grow exponentially in the future, then you buy that and you just let it sit. And so, yeah. So my son actually, and I love to talk about my little baby. He has a Roth IRA account.
Get out of time. Isn't he like 2, Keishan?
He is 18 months.
Oh my gosh.
This is the caveat also with having a Roth IRA account. So in order for you to have a Roth IRA account, you have to have earned income. If you don't have any earned income, you can't contribute into the account. And so let's say you only worked for the year and you only made $4,000, then you can only contribute up to $4,000 in that policy. Into that retirement account.
Okay.
And so my son, we did like some little modeling thing for him and they paid him some money. And so I said, you know what, let's put that money into a retirement account. And so when he gets older, he's gonna be like, my mom set me up.
That's right. Talk about built that generational wealth. You better go ahead, girl. You better go. He said he's 2 and he got a Roth IRA, 1.5. That is amazing. So you know what I'm gonna do after we get off? I'm definitely gonna be like on the Google schmoogle. Like, how do I get that? So we talked about investments. How do investments or assets affect our taxes?
How it affects, so honestly, it doesn't affect your taxes until you pull the money out, until you sell that asset, right?
Oh,
So you can put as much money as you want into these retirement accounts up to the limit. Like we talked about Roth IRAs, you can only contribute up to 6,000. With your 401k, you can contribute, I believe, up to 19,200. I believe that's the number for your 401k. But once you and then if you have your own individual account, outside of the retirement accounts, like I have a regular brokerage account that I put money in, you can put as much money as you want into those accounts. You don't have to pay any taxes. The only time you pay taxes is when you sell that asset. So if you are buying stocks and they cost you, $5,000 and you sell it for $50,000, then you have, well, I said you bought it for 5,000 and you sold it for $50,000. You have to pay taxes on $45,000 of income.
and how would, like, I'm pretty sure those companies will send you like some sort of special tax form, like, hey, you made $45,000 and
Yeah.
this is your tax form, and you have to now use that as part of your taxes,
Yep.
because that will be considered income, and the IRS is saying come up off our money. Okay.
Yep.
Okay.
So that's the thing. The IRS is like, how you on your phone and you're talking about something, and then like 5 minutes later you see an ad.
Yes,
That's what
ma'am.
the IRS is. The IRS knows everything. They know how much money you make. They know every single thing. So unless you're getting paid cash, they don't know about that. Unless you make a sufficient amount of money, and then whoever you're working for is going to report that information to the IRS. But baby, you can they know everything, everything. And
And
so
how do they, like, how is it that people, especially celebrities, get into tax trouble? How does that happen?
So I remember Cardi B did an interview and she said there are two people in her life once she started, making money, that she didn't play herself with. And that's one, she got a lawyer, a good lawyer, and she got herself a good accountant, right? And so I think people need to take ownership of their finances. So just because you're making a lot of money, you still need to be mindful of how everything is going. Because I was just watching a video about Fat Joe where he had to spend time in jail because his accountant wasn't paying none of his bills.
And I heard with his story, he had proof that he was sending the check to his accountant, and the IRS was still like, that doesn't matter. We did not care.
Yep.
You are still liable. I was floored.
I felt it for him because, he was doing the right thing.
Yes.
He was paying the taxes. And like you said, he had proof that he was doing it. And the IRS was like, I don't care. We didn't get the money. Yep. And they came after him. And he spent time, I believe, in jail for it.
Yes, he did spend time in jail for it. I cannot believe that you can spend time in jail for not paying your taxes.
Yeah,
I don't play with the IRS. You get your money, you get it. Like, it's like, take your money, please. Well, Keisha, this was good. Like, I really don't have any other questions. I do want to give you an opportunity to share with the people about first, any last words, anything you want to share, but also about your services and how people can get in contact with you.
I think the main thing is that whatever level you are at when it comes to your taxes, you just want to make sure that if you are going to take the initiative to prepare your tax returns on your own, that's fine. But just make sure that you are educating yourself to make sure you have the most deductions. And then once you feel that it's time for you to transition, prepare yourself to do so. I think a lot of times we live in a society where it's do it yourself.
Yeah.
Everybody want to DIY. Was it DIY?
DIY, yeah.
Like certain things you can't do yourself. You can't do your tax returns all the time on your own. Sometimes it comes to a point where you need to transition, and pay for someone to assist you. And so when transitioning, you want to make sure that that accountant adds value to who you are at the end of the day, and that accounting is educating you and making sure that you pay the least amount of taxes as possible.
And I'm sure Keishan does that in her services.
Yeah.
So tell people where they can follow you, find you, sign up for your tax strategic services and all that you do.
Well, so if anyone is interested in, signing up, getting their tax returns done, they can definitely send me an email. And the amazing thing, because tax season is ending May 15th, people have the opportunity to vet me out if they want to just find out a little bit more about me. So you can send me an email at legacytaxteam@gmail.com, or you can send me a message on Instagram at the_legacy_lady. That's just it. I was about to say .com. Or you can visit my website at KeishanRowe.com.
And all of that will be in the links.
Yes.
Wherever you're listening and watching, we'll definitely put those links in there. But Keishan, this was amazing. Like, when I say it is so beautiful to see women who look like us out here educating us, because we need this. I'm still upset over the $10,000 house bill. What is it? The $10,000 property tax. I feel it, and I'm not a homeowner. I feel away. I'm like all of these things, and knowing that you could deduct $10,000 of your unemployment, all these things that no one's telling us. And I think we need like a town hall meeting, because these laws are being passed, and then they influence us, and we don't even know what's going on. And that's also why it's important to vote.
Yes.
Who you're voting into Congress, who's representing your communities, and those things, like you said, taxes affect schools and all of those. These are these things that matter. We need to get out there and vote. Make sure our voices are heard. Make sure that we're keeping abreast of all of this stuff. I'm mad the IRS doesn't send us an email like, hey, this is the benefit that you can get, but they don't. So thank you so much, Keishan. Keishan is @the_legacy_lady. To find her on Instagram, you can find her website, KeishanRowe.com. All her info will be in the link somewhere if you're watching or listening.
Yes.
And thank you so much for listening. I hope that you listen to this episode again, like with a pen and a paper, because I know there were things that you probably like, what did she say? So feel free to ask her, reach out to her with any questions, and make sure to subscribe and share with a friend, and always continue to be a woman who embraces her legacy. Thank you for listening. Good night.
Thank you for tuning in to the Embrace Her Legacy podcast. If you enjoyed this podcast episode, please make sure to subscribe and visit embraceherlegacy.com to make a donation or sign up to become a part of our community of volunteers and supporters, the Embrace Her Legacy Collective. Make sure you follow us at Embrace Her Legacy to get daily inspiration and join our movement. Thank you for listening, and remember, you're enough, you're worthy, and you're a phenomenal woman who embraces her legacy.